Select 50 Fund Focus. With me in the studio today is Michael Clark. Michael, thank you for joining us.
Thank you.
Now, Michael, many people will already know you from the Money Builder Dividend Fund. You also run the Enhanced Income Fund. Can you tell me how these two funds differ and what the similarities are between them?
Well, Enhanced Income has the same stocks in it as the Money Builder Dividend Fund. The difference is the yield. So Enhanced Income has a yield of 7%, which is a couple of points higher than Money Builder Dividend. We achieve the 7% by overwriting the portfolio. So we sell to other parties the right to buy the stock in the fund at a fixed price. And for that, we receive a premium. And that's what gets you to 7% from 4.5%.
So that's the enhanced element?
That's the enhanced element.
But essentially,
right.
It's a UK equity fund?
It's a UK equity fund, yes.
Okay. So what sort of people might want to invest in the Enhanced Income Fund as opposed to, say, the Money Builder Dividend Fund?
It's clearly intended for people who want the extra income. So that might be people who are living on a pile of savings, retired people, for example. It's really designed for them.
Now, times have been tough for people seeking income. What, in your view, is the outlook for dividends going forward?
I think, there may be some examples where companies have difficulties paying dividends, but broadly speaking, that's not the case. I think most UK companies are run conservatively with strong cash flow, and they can afford their dividends. And it may be, especially if they have an international business, global business, that they can increase them over time. So I think the outlook for dividends is pretty secure. That's
going to be good news for income hunters, isn't it, at the moment?
Yes, I think so.
Now, you have a very specific philosophy, don't you? SIRP. Can you explain exactly what that means? Yes, of course. So what it means is safety, income and reasonable price. So the safety element means that we invest in companies of good quality. And what that means is companies where we can make a decent forecast about the company's trajectory and progression over the next 3 to 5 years and have some confidence in that forecast. So we're looking for good quality companies in non-cyclical, non-sensitive areas that are not sensitive to the economy. So for example, pharmaceuticals, consumer type companies, insurance companies, companies that are stable. So that's really the first point of SIRP. And then the income point is the I part of the SIRP. We're looking for companies that can pay a decent income which is sustainable. So not necessarily the highest yield in the market if it's not sustainable, but a good quality yield that where we see some possibilities of growth over time. And reasonable price, we have to make a judgment about the price we pay. So we value the company using various techniques so that we don't overpay. So that's how you get to SIRP. Michael, thank you very much. Thank you.